The intimidating jargon surrounding digital currencies, trust me, you are definitely not alone. It's a lot, but today we're going to demystify cryptocurrency together. We're going to strip away all that complex tech speak and break down exactly how this revolutionary system actually works, how people track its value, and really why it's fundamentally changing the global economy. So grab a notepad, get comfortable, and let's decode crypto.
All right, here's our roadmap for today's session. 1. Blockchain basics. 2. A core concepts review. 3. Candlestick charts. 4. The psychology of greed, fear, and volatility. And finally, 5. Global adoption.
Okay, let's dive into this. Section 1. Blockchain basics. Splitting the bill.
So to truly understand cryptocurrency, we've got to understand the underlying technology it runs on, which is the blockchain. Imagine 4 friends, Jack, Ted, Sam, and Phil, go out to dinner. Jack pays the bill, and the next day the others need to pay him back. Normally, we'd use banking apps to handle this, which can sometimes fail or charge unexpected fees. Well, crypto skips the bank entirely. Let's say Phil sends Jack some Bitcoin. The moment he does that, a digital record, which we call a block, is instantly created. This block permanently inscribes the transaction details and is securely linked to the previous block of data. It's like a giant puzzle. This chain of blocks acts as a public distributed ledger. That means every single friend in that network gets an exact copy. If Phil tries to send money he doesn't actually have, the friend's copies of the ledger will show his true balance and the network immediately flags and rejects the transaction. Boom, no central bank required.
Now you might be wondering, how do you actually store and send this digital money? You use a crypto wallet. It's kind of similar to your traditional online banking app, but with some absolutely crucial differences. In traditional banking, you have an account number that you give out and a password that you keep totally secret. In the crypto world, your bank account number is called a public key. Anyone can know it, totally fine. But your password is your private key, or sometimes a secret recovery phrase. You use this private key to digitally sign your transactions. But listen to me carefully here. This is the absolute golden rule. Unlike a bank where you can just hit forgot password if you get locked out, if you give away your private key in crypto, it is literally exactly like handing a hacker the keys to your life savings. They can take everything and there is no customer service desk you can call to get it back.
Moving right along to Section 2. Core concepts. Exam review.
All right, time for your first pop quiz question. I want you to think back to our 4 friends splitting that dinner bill. What is the specific concept that ensures data cannot be altered, forged, or hacked by any of the individual users within the network? I'll give you a second to think about it.
Got your answer? It's the public distributed ledger, because every user, which we call a node in the network, has a replicated copy of the entire transaction history. A hacker cannot just alter the data on their one computer. The rest of the network will cross-reference their own ledgers, see that the math doesn't match up, and quickly reject the fraudulent alteration. It's a brilliant system of checks and balances.
Excellent. On to question number 2. Different cryptocurrencies use entirely different complex algorithms to secure their transactions. But what is the specific hashing algorithm used by the Bitcoin network?
And the answer is SHA-256. This is the incredibly complex mathematical problem that computers on the network, which we call miners, are constantly racing to solve. This whole process is known as proof of work. The very first miner to solve the SHA-256 puzzle for a batch of transactions gets the privilege of adding the newest block to the blockchain. And for doing this critical work, they are rewarded with freshly minted cryptocurrency. Now, this reward regularly halves over time to keep the supply controlled, but this elegant system of proof of work is what keeps the whole network moving and completely secure.
Let's pivot to Section 3, Candlestick charts, reading the trends.
And this brilliantly illustrates how we actually track this digital value. Traders use a visual method that was actually invented by a Japanese rice merchant named Hanma Monahisa all the way back in the 1700s. Crazy, right? It's called the candlestick chart. Each candle you see here on a daily chart represents one single day of price action. A green candle means the price went up that day, a red candle means it went down. The thick part of the candle is the body, which tells you exactly where the price opened and closed. But see those little lines sticking out of the top and bottom? Those are called the wicks. The top wick shows you the absolute highest price the crypto hit that day, and the bottom wick shows you the absolute lowest.
By looking at the relationship between the body and the wicks, you can actually read the market's momentum. A really long wick on top means lots of people were selling rapidly, pushing the price back down. A large wick on the bottom means buyers quickly stepped in to scoop it up. But if you see a daily candle that is mostly wick and has almost no body at all, well, that indicates a very weak trend. It suggests that the current trend, whether it's going up or down, is completely losing steam, and a sudden sharp price reversal could be right around the corner.
Which brings us to Section 4, Greed and Fear, the Psychology of Volatility.
So reading charts is super helpful, but what actually drives these wild price movements to begin with? I mean, the crypto market is famous for its extreme volatility. While a traditional stock moving 5% in a day is a really big deal, in crypto, a 5% move can happen in minutes. It is entirely normal for prices to swing 10 to 30% in a single day. And this triggers intense emotional reactions, especially for beginners. When prices surge, people feel intense greed and rush in to buy, terrified of missing out. When prices crash, they feel sheer terror and panic sell. Believe it or not, these predictable, raw human emotions of greed and fear are the entire basis of trading assets.
Now, what's really interesting about this slide is the theory of the composite man, which was proposed by an early 1900s trader named Richard Wyckoff. He theorized a sort of invisible entity who sits behind the scenes and manipulates the markets to your disadvantage if you don't understand the game. In the crypto world, we call these composite men crypto whales. These are huge institutional holders of cryptocurrency who deliberately manipulate prices, creating sudden artificial drops or spikes specifically to trick new emotional traders into buying or selling at the absolute worst possible times.
Zooming out a bit, let's look at Section 5, Global Adoption, Institutions and Governments. Between the complex tech and that wild market volatility, you might honestly wonder why anyone bothers with this stuff at all. But it goes way, way beyond just individuals trying to get rich. Look at these real-world use cases. Massive global entities are validating and adopting this technology right now as we speak. Walmart actually adopted blockchain to permanently trace its supply chain. So when a customer flags a damaged product, Walmart can trace the immutable blocks backward from the farm, to storage, to transportation, instantly identifying exactly where the failure occurred. And on a macro level, entire nations are getting involved. The island nation of Malta has established itself as Blockchain Island, creating a massive fintech hub attracting major crypto exchanges. Meanwhile, El Salvador is planning an entire Bitcoin city, funded completely by digital bonds.
But we have to talk about the elephant in the room. This massive global adoption comes with a very real physical cost. To put this into perspective, if Bitcoin were a country, it would be in the top 30 energy users worldwide. It consumes more annual energy than the entire nation of Argentina. This is because that proof-of-work mining process we talked about earlier, where all those computers race to solve the SHA-256 algorithm, requires vast, highly specialized data centers running non-stop. And as the price of Bitcoin goes up, more miners naturally join the network, demanding even more electricity.
Let's move to and see how this builds into something positive, though, because the industry is actively trying to turn this massive environmental challenge into sustainable infrastructure. For instance, there's a company called Crusoe that sets up data centers directly at oil drilling sites. They capture and use natural flare gas that would otherwise just be burned off into the atmosphere. In Texas, massive crypto miners are actually helping balance the power grid. They voluntarily shut down their operations during peak demand times, like heat waves, to sell unused power back to the grid. Plus, the broader crypto space is exploring entirely alternate consensus mechanisms, like proof of stake. That method eliminates the need for all that high-energy computational puzzle solving entirely.
And that brings us to the ultimate question of decentralization. Think about it. In the early days of the internet, or Web 1, we just looked at static pages. Then came Web 2, which was highly interactive but entirely owned and controlled by just a few massive big tech corporations. Cryptocurrency represents Web 3. In this model, the underlying networks aren't owned by a faceless corporation. They are literally owned by the people who hold the tokens. By earning or buying a piece of the ledger, you actually own a stake in the infrastructure itself. So as this technology rapidly moves from geek money to the global mainstream, whose rules will govern the future of our digital economy? The centralized giants of the past or the decentralized token holders of the future? It's a fascinating shift to ponder.
In this cosmic expanse, Bitcoin and Ethereum orbit as celestial titans.
When we talk about cryptocurrency, it is so incredibly easy to just get lost in the digital cloud, right? We think about invisible blockchains, abstract lines of code, virtual wallets. But today, we're going to anchor that abstract concept directly into harsh physical reality, because this digital revolution is leaving a massive, highly visible footprint right here on Earth. In this explainer, we're diving into exactly how a technology designed to be totally untethered from physical banks is literally warping local infrastructure, altering everyday economies, and sparking massive global regulatory wars.
Here is our agenda for today. First, the physical cost of crypto. Second, a quick tutorial on mining and power prices. Third, Wall Street versus central banks. Fourth, the push for regulation. And finally, number 5, El Salvador's global rebellion. Let's get right into it.
Section 1. The physical cost of crypto. Plattsburgh's reality.
When we hear the term crypto mining, I think a lot of us instantly picture sleek, futuristic servers in some high-tech lab. But let's look at Plattsburgh, New York, a small city of about 20,000 residents near the Canadian border that became the unlikely ground zero for a digital gold rush.
Their grim physical reality was actually an old, ugly, rundown discount store packed wall-to-wall with thousands of computers, and their only job? To just ruthlessly race against other computers all over the globe, cracking complex cryptographic codes every 10 minutes just to win a reward of 6.25 Bitcoin.
Now, here's where it gets crazy. Each one of these individual machines uses up to 3,000 watts of power. I mean, think about essentially running hundreds of high-powered hairdryers in a single room 24 hours a day, 7 days a week. When you stack thousands of these things together, the physical output is just intense. You need massive industrial fans constantly pulling in freezing air and blasting out immense heat, creating this deafening noise around the clock. The sheer carbon and energy footprint is absolutely staggering, and it immediately begs the question about the environmental sustainability of a currency whose actual societal value is still so fiercely debated.
Moving on to Section 2. Tutorial. Mining and power prices.
Okay, so you're probably wondering, if these machines are out there just quietly or, well, loudly, solving math problems, how exactly does this translate into higher utility bills for everyday residents and local businesses? It feels totally disconnected, doesn't it? But actually, the link is incredibly direct. It all just comes down to the raw basics of supply, demand, and local grid quotas.
Let's walk through exactly how this happens. First, Plattsburgh had incredibly cheap electricity generated straight from the Niagara River, which basically acted like a giant magnet for a major crypto mining company. Second, once they set up shop, those machines ran continuously. Third, the city actually has a strictly set quota of that cheap hydropower, and these miners literally chewed through the city's entire cheap supply. So, step 4, just to keep the lights on in town, the city was forced to buy supplemental power on the open market at much, much higher rates. And guess who those higher rates got passed directly onto? Yep, the local residents and everyday businesses.
I mean, it is just staggering to realize that a single building was consuming 1/3 of the entire city's electricity. Just wrap your head around that. A city of 20,000 people and 33% of its total power was being sucked into a single, rundown former discount store just to solve algorithms.
So the local toll here was devastating. Initially, the pitch was great, right? The mining operation promised new jobs and a massive boost in tax revenue. But the reality? Basically 0 new jobs, because these machines run themselves. No local tax benefits ever materialized. Instead, you had residents and local factory owners who couldn't even afford to heat their homes or run their businesses because of the spiked electricity costs. And the kicker? The mining company was generating an estimated $50 million a month in profit. When Plattsburgh's mayor finally cracked down, they just packed up their computers and moved on to the next cheap town. The locals were completely left holding the bag.
Section 3. Wall Street versus central banks.
While these small towns are left dealing with a physical infrastructure nightmare, the financial capitals of the world are actively battling over what this technology actually represents. Look at Europe's banking capital, Frankfurt. There is a fierce institutional divide happening right down the street from each other. On one side, the European Central Bank views the idea of creating money outside their oversight as totally unthinkable. They aggressively label Bitcoin a purely speculative bubble with 0 real utility. But literally just down the road at the Frankfurt School of Finance, researchers are arguing the exact opposite. They don't see it as everyday spending money, but rather as a store of value, kind of like a digital equivalent to gold, that could become absolutely crucial if traditional currencies suffer from prolonged inflation.
And sure, critics love to point to Bitcoin's extreme volatility. But hedge fund manager Jordi Visser makes a really fascinating counterargument when you look at the 2022 market crash. Yes, Bitcoin absolutely plummeted, dropping 60%. But look at Amazon. It was down nearly 47% in that same window. Visser's argument is that volatility in the crypto space is actually cooling down over time, and it's starting to behave way more like a highly weighted traditional tech asset rather than just some unpredictable Wild West commodity. But then, of course, you have the ultimate traditional Wall Street perspective, completely dismissing any intrinsic value in the technology whatsoever. Legendary investor Warren Buffett basically makes the case that assets have to actually produce something. Farms produce food, apartments produce rent. Bitcoin, in his eyes, is quite literally just a series of numbers being traded back and forth. You're simply hoping some other guy is going to pay more for it later than you did today.
Section 4. The push for regulation.
So the entire core ethos of cryptocurrency is decentralization, right? Operating completely outside the traditional banking system. Crypto purists, like the influencer Wendy O, use peer-to-peer trading to totally sidestep banks, which they view with deep, deep suspicion. For the diehard advocates out there, using centralized exchanges like Coinbase or Binance completely misses the point, because you're essentially just recreating the exact same banking system you're trying to escape. Peer-to-peer trading keeps the power and the absolute privacy entirely in the hands of the individual.
But as we've seen, that unregulated freedom can have a really dark side. That lack of oversight led directly to a staggering $250 million bail bond. That's the amount set for Sam Bankman-Fried after his massive FTX exchange collapsed and completely wiped out billions in customer funds. When you have zero oversight, you essentially leave the front door wide open for monumental fraud. The whole collapse of FTX was a devastating blow to the crypto-utopian narrative, proving to regulators everywhere that without some form of guardrails, ordinary people are going to get financially ruined by bad actors.
So the proposed solution from the European Central Bank is basically offering safety, but at the cost of the very privacy that crypto advocates demand. To fight back against decentralized crypto and US tech giants, frankly, the ECB is developing what's called a central bank digital currency, or a digital euro. Sure, it provides stability and limits corporate power, but the crypto world is terrified of it. Why? Because a central bank could theoretically monitor every single transaction you ever make. It is the ultimate global standoff. The absolute freedom and inherent risks of Bitcoin versus the safety and potential surveillance of a state-run digital currency.
Which brings us to our final section, number 5, El Salvador's Global Rebellion.
Talk about whiplash from Warren Buffett's total dismissal. In sharp contrast, El Salvador's President Nayib Bukele has this absolute, unwavering devotion to the asset. He didn't just casually endorse crypto, he staked his entire country's future on it, turning El Salvador into the very first country on earth to recognize Bitcoin as legal tender. It was a wildly bold, unprecedented rebellion against major global institutions like the International Monetary Fund.
And to be fair, this national experiment actually started with a massive local success story. It's undeniable that an anonymous six-figure Bitcoin donation totally transformed the physical reality of a really impoverished, unbanked community called El Zonte, which is now famously known as Bitcoin Beach. The anonymous donor pumped in massive funds, but on one strict condition: the money had to remain in Bitcoin. Because these locals had zero access to traditional banks or loans or insurance, Bitcoin literally became their first functioning financial system. They traded in flimsy tin roofs for solid concrete homes, and they funded local initiatives that actively kept kids away from gang violence, a real game changer for that town.
But taking that isolated, charitable experiment from 2018 and forcing it onto an entire national economy by 2021, that revealed a very harsh reality. The government basically tried to jumpstart adoption by giving every citizen $30 in Bitcoin through the state-run Chivo app. But then the 2022 crypto market crash happened. Everyday citizens just watched their basic purchasing power absolutely plummet. Today, surveys are showing that roughly 70% of Salvadorans completely distrust the new currency, and its actual everyday use in the capital is incredibly sparse.
And yet, despite all that massive local skepticism and a staggering $1 billion price tag in a developing nation, the government is doubling down. They are pushing for this utopian, tax-free crypto haven called Bitcoin City. They literally want to power the whole thing using the geothermal energy from a volcano to sustainably mine Bitcoin, hoping to draw in massive foreign investment. It is quite literally the ultimate collision of natural, physical Earth resources and the wild dream of a decentralized digital future.
So, I'm going to leave you with this final thought to ponder as we wrap up our explainer today. We have seen how just a few lines of code can drain a city's hydropower and stick locals with skyrocketing bills. We've watched traditional central banks totally panic, and we've seen a developing nation bet its entire sovereign future on a digital coin. The physical footprint of this technology is absolutely undeniable, and honestly, this global regulatory war, it's just getting started. Thank you so much for joining me on this deep dive. Until next time, keep questioning the systems that power our world.